G'day expats and welcome to another episode of Expat Chat, joined today by my friend and colleague James Ridley, who's the Managing Director of the Asia Pacific region on episode 44. 44, episode 43. G'day James.
G'day mate, thanks for that. How you going? How's the desert treating you? Or I suppose the sandpit. You just said you had a storm, I think, over the night.
We had a storm last night. That was nice. Actually, it was funny. We've been getting a bit of drizzle, and you know when your family's been in the sandpit too long is when your daughters run out into like 5 or 6 drops and get excited by it. But you know, we like our rain when we can get it here, and it was nice to get a bit last night. And they're talking about more coming through, hopefully in the next day or two. But this will be the last hurrah before we jump into summer. And and then 50 plus degrees and humidity and all the jazz that goes with that. So embracing the cooler climate and the rain, that's for sure, mate. So how's things in Oz?
Well, we've been smashed, and by probably the last couple of weeks of just shit weather. Obviously La Nina, I think it's called.
Yep.
But it just seems to be the wet season at the moment. Every week it's overcast and usually getting patch of rains every day. And as we head into winter, you're really starting to feel it, but can't really complain. Can't whinge. It's just that season. I think La Nina is only meant to last probably another couple of months, and then that's it. So it is what it is.
Well, we all sort of got caught out because we don't look at our weather apps here. Because you wake up and it's sunny. It's sunny.
Yeah.
It's sunny. So especially this time of year. So and when it started raining, I was like, what? And then, the roads go to pieces because, the majority of people can't drive a car during the good times, let alone when there's a bit of water on the road and oil and mixed in with sand and stuff. And you just see cars spin out in front of you. And everyone's a bit of a moron on the road. So
that's crazy.
And it's that time of season, but enjoying it while it lasts, because once Mother Nature flips that switch, we're into lows of high 30s and middays of mid 40s and sometimes even the 50s, and
might have to start bringing out the polo shirts, make it a bit easier on yourself.
Look, it's not too bad. I mean, the place is designed for AC. Yeah. So the funny thing is, if you're inside, you actually rug up, because 9 times out of 10, whether you go to the cinemas or the malls or wherever, it's freezing. So you actually want to have a bit of coverage on. If you walk outside 100%, you're going to feel it. But when you go from an air-conditioned car to an air-conditioned mall or cinemas, you're cold. So, that's par for the course. But certainly the polos in outside of the office and outside of the malls is the attire of choice. That's for sure.
Yeah, that's right, mate. And what were your thoughts on that recent figure that came out on inflation, CPI in Australia?
It's big. Five. Cracking 5 is a huge thing. Especially given the fact that everyone was expecting 4.6s, 4.7s, to go into 5, and what the Reserve Bank look at is what we call the trimmed mean inflation figures, and that sort of takes out the volatility and pricing, and even that blew them away. So to me, a rate rise next week, as a laydown was there, it just depends on how big. At the bottom end of the scale, people are talking about 15 basis points or 0.15%. Top end, we're talking 0.5, 0.6, 0.4, 0.5%. It's happening. And if you look at the property market, they've been anticipating this already. You've got clearance rates at auctions going down a lot. When everyone's used to 80s and 90s, now they're down in the 60s. Mortgage applications are down, everything's down. So I think we're starting to see the early effects of that end of easy money. And it's going to be interesting 12 months to see what happens. I mean, futures markets right now, I think we're talking about by February next year, 2.8% official cash rates, which is, originally it was 3% by August. Now we're talking 2.8 by February. So it's going to be
how many rate increases that is. Like that's a very aggressive hawkish view on rates going up that quick. I don't think it'll go up that quick personally, but I think with that CPI figure, I think, the RBA is somewhat bullied into probably moving next month. I think taking up to 0.25 and then winding out the end of the financial year to probably 0.5, July maybe 0.5. That would make sense. Where our CPI figures are always a little bit more delayed, or CPI is always a little bit more delayed compared to the US. But it is our time now to start moving on those those rates. And it was funny. I was talking to you before we kickstarted this episode, that picture you put up of Scott Morrison on your LinkedIn, where it looks like he's just reading that graph, and you can just almost mouth what he's saying.
Crapping his DAX.
Yeah. Shit.
Yeah.
I mean, you see these guys, especially Scott Morrison and Frydenberg talking, and they're just getting thrown now with hard-hitting questions about inflation. So what are you doing to drive down inflation? Sort of playing the blame game a bit, but it's not their fault where inflation sits, to be honest. It's literally been brought on by COVID. So a lot of these questions that a lot of journalists are asking, they are asking the wrong questions. A lot of what's going to happen associated with interest rates and cash rate going up, that's out of their control, members of parliament. That's to do with the RBA, and sometimes to a degree even APRA. So they're asking the wrong questions, and I say that and sort of drop that about members of parliament, because one of the campaigns that's I suppose out in the open right now by Clive Palmer is saying he's going to keep interest rates under 3% for 5 years. He's got no control of that, so I don't know how that's legal, but it's been a funny one that's been out in the open probably for a couple of weeks now. Typical Clive Palmer.
Clive gets away with what Clive tries to get away with, and I think that's the biggest thing out of all this sort of stuff. It's just, unfortunately, there is a percentage of the population, how big, who knows, that will just take him at face value and go, fantastic, 3% for the next 5 years. Let's vote him in.
That sounds good.
It's probably relying on that, and they won't realise that he has got no control of it until he's voted in. I don't know. I mean, probably the benefit of being overseas is you don't have to be exposed to this stuff on a daily basis. Like, you choose to opt in. If I want to go and look at, articles and stuff about, the politicking and electioneering going on, I can do that. But I'm enjoying not being hounded and having this stuff thrust in my face in advertisements every 5 minutes.
Yeah, I think, as we've said before, there could be quite a few donkey votes next month.
Yeah.
I'm still those out there
who remember that movie called Brewster's Millions, but none of the above.
Yeah, exactly right. Now, Matt, I wanted to dive into today's topic, and we just want to touch on a few tips that I suppose future expats need to be aware of, because there seems to be a lot of people heading back overseas. I know there's heaps heading sort of over into the Middle East and Europe as well, surprisingly. There's heaps heading to the US. So it's good to see that sort of theme starting to change again and switch on after sort of COVID, and everyone's starting to move to live with it, except for some of the Asian areas. But that being said, I wanted to talk about just some tips to be aware of as you leave Australia.
Yep, and mate, let's just get the jingle out of the way, the disclaimer out of the way. So before we get in the nitty gritty, so folks out there who are listening and watching, please treat this podcast as educational, comical, whatever phrase you want to call it, and almost with the same veracity of Clive Palmer making election promises. So it should not be construed as personal advice, and you need to speak to a professional. And just as a segue, we're talking to a lot of folks right now who are seeking advice, but they're not seeking advice from the right people. They're talking to generalists. They're talking to people who don't have a lot of match fit understanding of expat issues. So certainly speak to someone who deals with more than one expat when it comes to getting professional and personal advice.
Yeah, and I mean, one little thing that just came to mind when you talk and mentioned about sort of generalists, I guess one of my clients who works for one of the big four accounting firms, we know that those residency changes, they're still proposed 1 July 2022. He was saying that, he's an employee, he works overseas. Even sort of the summary that they put out to their global mobility sort of workforce, it's been not great. There's a lot that's been left out. Even the proposal that was put forward about the treaty interaction with the treaties system and the tiebreaker test, that's a really big one that no one's really focused on. But that's going to be pretty important for a lot of expats that are heading overseas. And if this is legislated, factoring that in that decision, is it worthwhile? Am I cut off? Those sort of things.
Look, the big one's going to be, and I'm talking to a lot of folks right now, actually congratulating them and applauding them for doing this now. And the reason being, because a lot of these folks coming out of the country don't have the requirements to classify as a non-resident immediately based on that 2-year contract rule. So, they're coming out of the country, they're trying to get a new job, they're not moving with an existing company or they haven't got a contract in place. If
Yeah.
they're going to a country like the UAE or any other country that doesn't have a DTA with Australia, they'll be considered as a tax resident for up to 3 years.
That's right.
So, when I tell them this, they're like, wow, this has just galvanized me even more to go because I don't want to be one of those people in a couple of years' time who are trying to get out of the country without a contract who, are going to pay a pretty hefty amount of tax on their overseas income.
Yeah, that's right. I mean, those rules, they are designed to be a bit more adhesive. Our tax system is a bit more stickier to not clients, but expats in general that are heading overseas. So it's something we all need to pay close attention to because whilst there is still a lot of water that needs to go under the bridge, seeing an explanatory bill still meant to be going full steam ahead 1 July 2022. I think it's unlikely, but again, we've seen what the government's like. They can just legislate things pretty swiftly and then there's no sort of heads up or anything like that. There's been plenty of consultation on those proposed residency rules. So we'll just have to see what comes about. But when we think about first heading overseas, there's a lot that's not really talked about. Even from the Big Four, they don't talk about certain asset classes, how it's changed, things to be mindful around your superannuation, personal insurances. If you're selling an asset whilst you're overseas, there's a lot that is left to be discovered by expats, whether it's their own research or speaking to, I guess, professionals like us. So let's go into a few things that just sort of future expats need to be mindful of.
Mate, I think the first one is the fact, and it's, I don't know whether it's ignorance or apathy or what, but assuming that how things work in Australia is the same overseas. And the biggest one for that is the change in taxing rights on assets. People expect when you are an Australian tax resident, property shares, they're all treated the same way. When they go overseas, they just assume that, it continues, and it doesn't. We have these distinct asset classes that, or taxing types on asset classes that really do come out to the fore. And the big ones are taxable Australian property, house, apartment, mining lease, farm. Best way to think of that is things that are physical, you can kick. And then we have non-taxable Australian property, shares, managed funds, ETFs, LICs, and crypto. And those do not accrue a tax liability. But unfortunately, we're still meeting a lot of folks who, when they come out of Australia, they don't understand, A, the changing nature of how that works, and B, key milestones or demarcations in your taxing rights. Deemed disposal is the big one. I was talking to a gentleman yesterday, and he's been operating with an advisor back in Australia. Obviously, this advisor, I'm sure he does a great job dealing with locals, but pretty much gave him some average advice. He's been overseas since 2019, didn't do deemed disposal on a 6-figure portfolio, living in the UAE, still accruing a tax liability. So, to me, deemed disposal to the folks out there, really, if you own shares or any sort of non-taxable asset, digital asset, while Australian tax resident, yes, you don't accrue a capital gains tax liability while you're non-resident, as long as you sever the umbilical cord with those shares as a resident versus non-resident. And that really comes down to paying the capital gains tax liability that you've accrued up until that point. Then from that point onwards, you don't continue to accrue a tax liability. And this to me is one of those low-hanging fruits for expats. If you've got a portfolio coming out of Oz, the fact that you can have a portfolio and it can grow unencumbered from a CGT point of view, it's great. But people aren't getting the advice, and they're coming out just thinking they read that shares are non-taxable as a non-resident, and they're a non-resident, so they just assume that they're not accruing tax, but in actual fact, that's wrong.
Yeah, absolutely. And I mean, you touched base on a really important point just before about how understanding, I suppose, and knowing what your responsibilities are, depending on the assets you have back in Australia, what still needs to be taxed, what isn't taxable. And I think a common one that I've run into a lot is property ownership back in Australia, and expats somewhat almost forgetting to lodge their tax returns to account for that rental income. That's pretty important, and it'll help in the future to understand, okay, whether it's positively geared, you are paying some income tax to the ATO. You've got to remember that when you do head overseas, that your income tax rates are changing. You're a non-resident, no tax-free threshold, 32.5% on the first net dollar. So it can be a bit of a surprise, the tax that you do start paying when you head overseas, especially when you move overseas and hypothetically, you've got a main residence, you've never rented it out before, you're going to start renting out, and then you're paying, $5,000 a year in tax, which you just weren't aware of. So a lot of expats, they do get a bit surprised, and then just the notion that they don't lodge their tax returns to account for that. That's pretty important, because I've come across expats that they've got 5 to 10 years worth of tax returns outstanding, and they've had a property rent that's been rented for that entire period. That can mean a very large tax payable with general interest charges that could get loaded on there. Or alternatively, that they might have been accruing some losses, but they can't really plan for the future if they don't know where they've come from. And if there's accrued losses on their tax returns, there's a little tax asset that they can use in the event they need to offset some gains. So it's just being mindful that good practice, or good, I suppose, good practice, good compliance is just staying up to date on your outstanding lodgements each year.
Look, I think it's great advice, because to me, the world is becoming a very small place from a data point of view. And, many years ago, you could jump on a plane and you just disappear off the radar, and little recourse possible. These days, the ATO's computers are dialed into the Department of Immigration. They know when you're coming and going. And I know people worry about it, because it's one of the first things they talk about when we talk to them. They're like, oh, I haven't done a tax return for a while. And when you run through the problem and work the problem, 9 times out of 10, they're accruing losses anyway. It's like, well, get it done, because you're actually accruing losses. Yes, you'll be some general interest charges, and if you are creating gains, but and maybe even some penalties if you have late lodgements. But at the end of the day, if you're running a negative cash flow of tax credits to you, yes, you get a slap on the wrist, but then it's done, and then you're not having to worry about it again. The other one too that we see a lot of confusion with is when you don't own any Australian sourced income, and people just think you don't have to do a return. Technically that's not right. And the easiest way to deal with that, if you've got the most vanilla of financial circumstances, you can log on to MyGov, and go through the ATO and do a non-lodgement advice. It just says, hey, I haven't any Australian sourced income, talk to you next year, see you later. And it probably takes the better part of 10 minutes to do. And then as far as the ATO is concerned, you haven't got 10 years worth of outstanding lodgements due, because you're just spending that 10 minutes once a year just going in and saying, hey, nothing to report, catch you next year.
Yeah, that's right. And I mean, taking that a step further, and sort of good segue, one of my good mates, he's heading over to London shortly. There's a visa that Australians they can exercise, and they have to do it before a certain age. And he's capturing that, but he doesn't have any work lined up, which I was kind of shocked, because he's leaving a very good role from APA. And he's heading over there, but he was talking about, what's the go with HEX? Can I just leave that in the wind now? I don't need to worry about that. I was like, no, that's not right. Like, even if you Google HEX ATO repayments, it'll come up first thing. When you leave, you still need to obviously do your HEX repayments. So that's probably, another call for the fact that you do need to make sure you stay up to date with your lodgements. Okay, no Australian sourced income, great. You still do have a HEX lodgement to do if you are still earning over a certain threshold. The threshold these days is quite small. I think it's as low as 40,000. If you're earning as low as 44 or 45,000, you do get captured, and you have to make a little repayment, 1%. So it does start from 1%, tiers up to, I think, pretty aggressive, almost 10%, depending on your income level. But I had to give him the bad news over a beer, and just said, yeah, you will have to do a HEX lodgement, depending on what your income sort of level is. It could be a nasty little lump sum payment. Put yourself on a payment plan every year, and then clear it over a 12-month period, and then go again. Do your next HEX lodgement as the financial year rolls around. But he was shocked. Maybe pay for the beer as well. So there you go.
Price and a free beer.
Yeah, that's right. So that was a good little segue into just knowing that, okay, when you leave, you still do have responsibilities, especially if you've still got a HEX debt. That's a good little key example.
Yeah, and I think the HEX debt's a good one, because to me, a lot of folks are earning pounds, euros, US dollars, or US dollar variants like dirhams and reals and those sort of things. And when you declare your income, you're declaring an AUD. So if you're earning £30,000, while it doesn't sound like a lot in the UK, when you convert that to Aussie dollars, bang, you're right in the sweet spot of that threshold in terms of having to make repayments. And UK is not a cheap place to live. So, and this comes off your gross salary, not your net. They'll factor in tax deductions and those sort of things, but you're declaring your gross income. So that's a big one that we see a lot of. And people say, oh well, maybe I won't do it. And I think last time I saw the ATO's announcement, there's a fine of $3,600 per annum if you're not making those lodgements. And do you want that hanging over your head like a guillotine?
Well, it's more so also there you go, say that quick. The general interest charges that can get whacked on you. GIC provided by the ATO, it's not sort of a indexation rate or anything.
It's not 1% or 2%. Yeah.
Usually, I think it ranges between 9 to 11%. To be honest, it's pretty hefty. So
pretty steep.
It is worthwhile. Getting them done and sorted.
Yeah. No, exactly right. So, mate, on to the next one. I think this one is something that affects pretty much everyone. Super. People go, what do I do with super? The good news is super's agnostic to residency, excluding self-managed super funds. So that's in highlight bold. So this conversation we have right now will exclude self-managed super funds, and then we'll touch on SMSFs next. But mate, do you want to run through super and how that works as an expat?
Yeah, well, you hit the nail on the head. It's agnostic. So regardless of your residency, there's a lot of myths that get sort of caught in the traps around, if you contribute to super, it's going to impact your residency. It definitely doesn't, unless you're an Australian government official that's been deployed overseas. That can definitely tether you back to Australia and still hold you captive as an Australian tax resident. But that being said, you still can contribute to super whilst you're overseas. I think superannuation, it's one of those things that is commonly forgot about when we leave, and that does make sense. However, more common than not, expats will return back to Australia. They will not have contributed to super for 5-10 years. There's a big gap in their retirement savings compared to Aussies that have stayed here. So it is worthwhile still thinking about contributing to something like super or something similar. And you can make after-tax contributions. You've got a big annual cap there, 110,000. You've got a pre-tax contribution cap of 27,500. So there's no shortage of how much, I guess you can get in each year. There's plenty of wiggle room there, but it is something that is left behind. So always worthwhile reviewing your super before you go. Even look into the insurances. A really common one that we always come across is very common that most people that have a super fund, they've got these default insurances on it, your life cover, disability, or TPD, and then income protection or salary continuance. Because those are default insurances, you've never been assessed or underwritten. A lot of the time, they can actually be invalid when you do head overseas. Different super funds, different insurance providers, they've got their own rules. So it's not as simple as just having a look online. You sort of do need to have a pretty hard call with the underwriters, but it's hit and miss. And if insurance isn't going to be valid for you while you're overseas, well, just remember those premiums will eat up your balance. I think I came across a client recently where their annual premiums are about $8,500, and they're going up each year. They're about 7 years out from retirement. That's going to eat into their balance pretty quickly when they haven't been contributing to super. Yep. It's also the case that, they are invalid. Why happened there? So that's a little key example, but as always, check the super fund, check the insurance validity. Probably another good point is consolidate. Get your super funds all in one basket rather than having them in multiple super funds and just getting eaten away by fees. That's probably the most common as well that we see, having 3 to 5 different super funds. Not too hard to consolidate these days. It's definitely something that expats need to be mindful of.
Yep. No, I think it's great advice. And now let's run on to the SMSF side, because certainly self-managed super funds are becoming more and more popular with Australians and how to manage their super. So let's run through why it's different to general super. And I think it really is a concept of if you're an SMSF or not. And by that I mean self-managed means you're your own trustee. So you're the gatekeeper and the beneficiary. Whereas with a general super, there's someone else who's the trustee, you're just the beneficiary. So do you want to run through some of the key rules with respect to how an SMSF retains its compliance and its tax deductibility?
Yeah, well, I mean, the main one there is central management control in Australia. So when you set up an SMSF, typically you're a normal Australian tax resident. And one of the key sort of tests that the ATO have is if it's established in Australia, which they all are, central management control needs to be maintained in Australia. Now, the way that the ATO looks at that firstly is, okay, well, there's likely to be individual trustees or, a corporate trustee with directors, which are the members of that self-managed super fund. And it would also be a case where 50% or more of the balance belongs to Australian tax residents, not non-residents. So that's a really good example of central management control, who actually, I suppose, is, taking charge of everything that's going on with that SMSF. Not necessarily, I suppose, simple day-to-day little operations, but I suppose the asset itself, the tax vehicle itself, when it moves into being, I suppose, treated as non-complying, it does mean that, the non-residents that own that SMSF, they're all overseas, they have the majority of the balance there. And, when that's found out by the ATO, that's obviously a big no-no. And, you can be penalised quite heavily. But there are some other tests that come on with that. I suppose the active members test, that's probably the most common one as well.
Yep.
Contributing aggressively to your SMSF whilst you're a non-resident. That's also a big no-no. You should be a normal Australian tax resident, should be contributing to it at all, to be honest, whilst you're overseas. I will add a caveat that depending on the country you're in, whether you should even have an SMSF, probably the best example is the US. The US is penalizes so many expats in the US, or the IRS penalizes so many expats for having an SMSF because they treat it as this foreign investment trust, foreign grantor trust, I should say, and they'll tax you on the growth, the income, everything within it. And obviously it means you're paying tax as you go on an investment that you can't even access because it's super.
And also, just on that too, I just want to point out to those folks in the US, you may see reference out there to some peoples or parties being able to claim this as a privatised social security. Don't. It is just...
Well, that individual... That individual's going through some very, very big court cases right now against him. So yes, obviously, not naming the firm or anything like that, but there is one main firm that takes a very unique position on superannuation, which is not shared by
anyone else in the world.
most qualified accountants outside of Australia, inside the US as well. They're for a bit of a rough trot, to be honest, for the next few years, going up against the IRS.
Yeah, so I think it's a good one there too. And look, to me, I think the last one, when it comes to tips and tricks for managing finances as an expat newbie, for me would be leave your Akubra back in Australia. That to me is the biggest one I see across a lot of folks coming out of Australia for the first time as an expat for the first time. They want to manage their Australian affairs like an Australian citizen, like an Australian resident, when in actual fact the tax rules ignore your citizenship. They tear up your passport. You are treated like a local resident in that country of domicile. And so strategies that are common, negative gearing, throw it out the window, rapid pay down of tax deductible debt, throw it out the window. There's a lot of things there. And to me, when I talk to clients, we talk about demarcating the way they manage the money based on the tax residency at the time. When you're overseas in country X, you manage your money, like so. When you return back to Australia and you tick that resident returning card, then you go into strategy Y, because the tax benefits are there. People are paying unnecessary tax. And I see a lot of it at the moment because people get overseas, get more cash flow, they start to try and pay down their debt. And guess what? Surprise, surprise, they're suddenly getting tax bills when before they didn't. It's like, well, you just paid off your biggest tax deduction, where in actual fact, you could have achieved that goal. If it is to, have zero debt, you can structure your cash flows in a different way so that you achieve the same goal when you return to Australia, but you're not worrying about those debt payments, those tax payments.
Yeah, that's right. Absolutely. It's good. It's a good point you make, to be honest, because I've been speaking to some clients where they've just turned into sort of positively geared territory on their main residence that they're renting out. They're like, okay, well, what do we do? How do we reduce the tax payable each year as well? It's like, well, there's not much you can do. You've done the traditional old way of doing things when you're a resident. You've paid down the non-deductible debt, and it's to that level now where you're paying obviously a bit of income tax. there are ways that obviously you can change it in the event there's an offset account. If there's not, then it's, there's more of an advanced strategy which focuses on an investment strategy there. But there's not too much you can do if you just paid off the debt, to be honest.
Yep.
You cop it, and you need to think differently about the way you structure things whilst you're overseas.
Yeah, I mean, the best way to think about it is if you're happy giving the ATO 1/3 of your positive cash flow, then do it.
Yeah.
If you're not happy about giving them 1/3 of your cash flow, then don't do it. Simple as that. It is as simple as that.
Yeah, I agree, mate. I think that's probably a good topic to finish on today.
Yep, wrap it up. Just I'll put in the show notes as well too. We touched on obviously inflation, interest rates. We addressed the implications for that back in episode 40 of Expat Chat. I'll put a link in below. And also to yourself and Jeremy, we'll be running a property webinar mid next month. So I'll put those details in the show notes below. So that'll be a good one to have a chat to, especially very topical right now with respect to changing and lending requirements, interest rates, property market, the whole shebang. So, mate, we'll wrap it up there and see you on the next episode.
Sounds good, mate. Speak soon. Cheers.
Thanks, mate. Take care.